Hey everyone, it's Chow Min, and welcome back to the channel. Today we're diving headfirst into the wild world of cryptocurrency. Specifically, we're breaking down the top 10 factors that influence the crypto market. Whether you're already dabbling in Bitcoin or just curious about what moves the needle, understanding these key drivers is absolutely crucial. Look, I'm not going to sugarcoat it. The crypto market is incredibly volatile. One day it's skyrocketing, the next it's in free fall. But here's the thing. Those wild swings aren't random. There are concrete reasons behind every surge and dip, and knowing what they are can be the difference between making smart investment decisions and getting burned. So buckle up, grab your notepad, and get ready to level up your crypto knowledge because in this video we're covering it all. Let's get started. Okay, let's start with the basics. Supply and demand. This fundamental economic principle is the bedrock of pretty much every market, and crypto is no exception. In a nutshell, when the supply of a cryptocurrency is low and demand is high, the price goes up. Conversely, when the supply is high and demand is low, the price drops. Now what makes crypto interesting is that many digital currencies like Bitcoin have a fixed supply cap. Bitcoin, for example, will only ever have 21 million coins in circulation. This limited supply creates a scarcity effect which can drive up the price as more people enter the market. Think about it like a limited edition sneaker drop. The fewer pairs available, the higher the demand and the crazier the resale value. Next up we have market sentiment, which is all about public perception and how people feel about the crypto market. This factor is huge, guys. Positive news, like a major company adopting a cryptocurrency or a celebrity endorsement, can create a wave of optimism pushing prices upward. We've seen this time and time again, right? On the flip side, negative news like government crackdowns or security breaches can trigger fear and uncertainty, leading to a sell-off and price drops. Remember when Elon Musk tweeted about Bitcoin's energy consumption? The market went haywire. That's the power of market sentiment, driven by news headlines, social media, and yes, even influencer hype. Governments around the world are still figuring out how to deal with cryptocurrency, and their decisions have a massive impact on the market. When a country introduces strict regulations, like China's crackdown on crypto exchanges, it can create uncertainty and make investors nervous, leading to price drops. On the other hand, when a country embraces crypto, like El Salvador adopting Bitcoin as legal tender, it can boost confidence and attract investment. The regulatory landscape is constantly evolving, so staying informed about new laws and policies is super important. Cryptocurrency is all about technology, and advancements in blockchain technology can have a major influence on market trends. For example, the development of faster transaction speeds, like what we see with the Lightning Network, can make a cryptocurrency more appealing for everyday use, potentially driving up demand. Similarly, the emergence of new applications for blockchain technology, like decentralized finance or DeFi, and non-fungible tokens or NFTs, can create entirely new markets and investment opportunities. The crypto space is constantly innovating, and those who stay ahead of the curve stand to benefit the most. Believe it or not, the global economy plays a role in the crypto market too. When traditional markets are booming and inflation is low, investors might be more willing to take risks, pouring money into assets like crypto. But when the economy is struggling, like during a recession or when inflation is soaring, investors often flock to safe haven assets like gold. Now, Bitcoin is often referred to as digital gold because it shares some similarities with the precious metal. It has a limited supply, it's considered a store of value, and it's not directly tied to government-controlled currencies. So, during times of economic uncertainty, we often see a correlation between the price of Bitcoin and gold. For cryptocurrencies to truly succeed in the long run, they need to have real-world utility and be widely adopted. When more businesses start accepting crypto as payment, when decentralized applications gain traction, and when smart contracts become more commonplace, it increases the demand and legitimacy of cryptocurrencies. Think about it. The more people are using a cryptocurrency in their daily lives, the more valuable it becomes. So, keep an eye out for projects and developments that are bridging the gap between the crypto world and the real world. Now let's talk about the elephant in the room: market manipulation. Because the crypto market is still relatively new and less regulated than traditional markets, it's more susceptible to manipulation. Whales, or individuals and institutions holding large amounts of a particular cryptocurrency, can potentially influence the market with their trades. We also see pump and dump schemes, where groups artificially inflate the price of a coin to make a quick profit, leaving unsuspecting investors holding the bag. It's crucial to be aware of these risks, do your research and avoid getting caught up in the hype. This one's specifically for Bitcoin. Every 4 years or so, the rate at which new Bitcoins are created is cut in half. This is called a halving event. This reduction in supply is hard-coded into Bitcoin's algorithm, and it's designed to control inflation. Historically, Bitcoin halvings have been followed by significant price surges. Why? Because when the supply of new Bitcoins decreases while demand remains constant or even increases, it creates upward pressure on the price. It's basic economics in action. The world of cryptocurrency is incredibly competitive. Thousands of cryptocurrencies are vying for attention, each with its own unique features and value propositions. This constant competition drives innovation, with developers and entrepreneurs pushing the boundaries of what's possible with blockchain technology. However, it also means that some cryptocurrencies will inevitably become outdated or irrelevant. Think about it like the early days of the internet. Not every website from the 90s is still around today, so it's essential to diversify your portfolio and invest in projects that you believe have long-term potential. Last but not least, global events can have an indirect impact on the crypto market. During times of political instability or economic turmoil, people and even countries might turn to cryptocurrencies as a safe haven for their wealth. For example, when a country's currency is rapidly depreciating due to hyperinflation, cryptocurrencies can offer an alternative store of value. We've seen this happen in countries like Venezuela and Zimbabwe. So, while not a direct driver of the market, geopolitical events can certainly create ripples that are felt throughout the crypto world. So, there you have it, the top 10 factors that are driving the crypto market. As you can see, it's a complex landscape with a lot of moving parts. But by understanding these key drivers, you can make more informed decisions and hopefully avoid some of the common pitfalls. Remember, cryptocurrency is still a relatively new and volatile asset class. Don't invest more than you can afford to lose, do your research and always be prepared for the unexpected. Thanks for watching. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell for more insights into the world of cryptocurrency. Stay informed and invest wisely.